Hello, this is Danvi from danvi-charting.com. In this video, we will look at factors that can help us in managing the risk of trading, and particularly the risk in options trading. But the general principle would apply across all financial markets that we can trade. But before we get into the content, this is a common disclaimer. Please stop the video and read through the disclaimer. In brief, it is informing you that the content of this particular video and all the other videos that I produce are purely for illustration and educational purposes. They are not to be interpreted as a form of advice or recommendation to do anything, and trading financial instruments are risky and may not be necessarily suitable for all. So with that said, let's proceed. You will find lots of different sources with a variety of materials available which talk about the subject of risk management. Now this can be a very extensive subject, and I don't need to go into the great details because a lot is available on the internet and various publications that you can access. But the comments that I'm going to be making in the area of risk management will be based on things that I have experienced myself and things which I find is not so commonly referred to in mostly published materials or any other commentaries or resource material that you can find. So first of all, when we are looking at managing the risk, I think the most important factor of this is having the right mental disposition, and it covers a broad subject, but in essence these would be things like revenge trading, rage trading, ego trading, trading to demonstrate your ego. It could be all manners of things where your mental disposition would be called into question and would in fact have an important factor in whether you are able to trade successfully and manage the risk of trading financial markets. But I think even more than that, because those other things are effectively common results of mismanagement, of having the right disposition. The key element of having right mental disposition, I think, is understanding our limitations. We are all different. We all have a different physical, mental makeup. We all assimilate different things, and we have different levels of skills and abilities in this particular aspect of financial trading, and in fact in any endeavors. We all have varieties, and therefore we vary in our level of skill, knowledge and ability to act. So understanding our limitation is very important, and in this particular respect, understanding our limitation in terms of our financial resources. We may not be able to have the same resources as somebody else might have, and therefore we have to manage the risk based on our financial resource. What actually enables us, or what we have at our disposal to trade. So understanding that we have limitations on financial resources means that we will control our trading within the confine of what's available, not what we might desire or what somebody else's have. Likewise, we might be limited in the time that we have available for trading the market, analyzing and following. Others might be able to do it full time, and some might not be able to. They might have a limited time, so they'll do it part-time, or even just like a hobby, like casual. For them, they may not need such an extensive amount of time. So we all have different times simply because our life is filled with so many different competing responsibilities, means that juggling all of this about is not easy. So we have to understand what time we have available for allocating to research, analyzing and planning trades, and then trading and following trades, etc. We have different mental energies. Some can be very studious, others cannot. Some can sit extensive period focused on one particular subject, some might find that very hard. And we all have different levels of skill. So understanding these limitations, which enables us then to see how we may construct our plan for trading, how it will have to suit our particular circumstance. We have to accept that we won't be able to catch every moving instruments. There are so many, and every one you look at looks so enticing. Sometimes you think, oh, I wish I would noticed that one before, because it might have been particularly a very impulsive and very dynamic move, maybe more than the one that you were perhaps trading. So with the hindsight, it's always easy to see that you missed something, that you missed the market. So we have to understand that we have limitations. We have limitation in terms of time. Our mental energy and a skill level means that many times, and even if we had all of these, there are so many instruments to choose from, so we won't be able to catch every moving instrument. We have to understand that. We have to accept that and not feel regret or feel that we have failed, or in some way think that maybe you need some additional level of skill so that you can capture all of this. It's not possible. We have to accept the reality. We also have to understand that because the market is so dynamic and often very leveraged, we may not be able to catch all the highs and all the lows. Sometimes you might find that we are very close to it, but either we have entered a little bit too early, or sometimes we might have entered a little bit too late. But regardless of any of these, if we have captured approximately the area for planning our trades, either going long and then finding a low to enter, or finding a retracement high in order to enter short. But we will not be able to capture an absolute high or a low. So that's another limitation we have to understand and accept. And it's no point arguing against this or constantly looking for ways to see if you can. It's just physically not possible to do it consistently. We might be out in timing. Everything else will be fine. Even the levels might be right. We may be slightly out of timing. And if that's the case, it may be that we might be caught in a range. And then begin to wonder whether we are going to actually have the move we are anticipating. Or is it just going to congest like that and maybe follow a different path? So these are limitations, and we will also get them wrong. Sometimes we will completely misjudge the price. We'll be completely out, diametrically 180%, 180 degrees. We might be expecting a move in an upside, and it might congest and actually break to the downside. So we will get things wrong as well. So having a correct mental disposition that we won't be right all the time, and depending on our abilities, we are all different. We may have different resources available for us, time. So these limitations will have boundaries on our general trading plan, and that for that reason our trading plan would look very different from somebody else. The other area that we need to consider where our trading plan would differ in our attempt to consider how to control the risk involved in trading financial instrument is that we have different circumstances. We briefly mentioned on some of them in the earlier slide, but supposing if you're working full-time, that's taxing in itself. Maybe when you come home you're tired, you might not have the level of energy and time available to allocate to market analysis and research and following the market extensively. So you may be limited in that. We might have domestic responsibilities. So maybe even after coming back from work, we might have domestic responsibilities, means that we will be limited in time. Our skill level, our background, both in terms of our educational background and our occupational background, may vary so much. The financial resources available to us means that we might have only a limited capital. But in all of these aspects, we are not in competition with anybody. The whole idea about being able to trade and to manage the risk and develop a plan to help us do that, to taking into account the factors such as these, means that we might still be able to trade, but it will be based on our circumstance. And generally, this would mean that we have to pick the method that best suits us. If other people use this different method, and for the reasons outlined we cannot, then maybe we should be satisfied in that. We should not feel that we are missing out. Can you imagine a circumstance where maybe, say for example, in National Reserve Park in Africa, we have a vantage point or a hiding place from which a predator will be seeking prey, and in front of him there will be an entire field filled with wild beasts and other prey. Now if he was to focus on all of them, surely he will probably fail in being successful in capturing any. Or when he captures one, can you imagine he would sit back and think, whilst I've caught one, but look all the ones I've missed. So that kind of regrets would not help us. We are not in competition with anybody. We have to ensure that whatever resources available to us, and if we are inclined to trade and accept the risk of trading financial markets, we will do so in the way that it suits us, both in terms of amount of time it requires, level of skill and ability it requires, and financial resources available to us. We might even want to specialize in just one type of trading, because having specialized in one type of trading and doing the same thing over and over again on a repeatable basis could easily help us long term to be successful. And that success would not be compared to anybody else. It's our success. So one of the way we can consider in refining the area of financial market we would trade is, rather than follow everything, rather than to look at hundreds and hundreds of different instruments, is maybe narrow it down based on the most liquid part of the market. So in contrast, I have seen many traders, and probably they can trade successfully, but many traders will trade like a penny stocks or stocks in a very low single digit, $2, $3, $5 stocks, because they think that maybe they can buy a bundle of those, and if it only moves few cents, they will make few $100. But then many of those stocks are not as liquid, and because they're not as liquid, there are a number of problems in trading that stock. One, when everybody wants to get out, you might not be able to. The price might actually drive the market against you. You probably have a gap movement, or the market makers will realize and they will increase the spread. So your cost of trading will go up. Suddenly part of your profit disappears. So because they're not liquid market, we can't enter in and exit almost at will without impacting the market. So we have to trade the most liquid part of the market. And you might be surprised what that might mean. There are many big stock index or stock in S&P 500 index which are classed as major stocks, but their overall average trade volume on a daily basis is probably less than 1 million. So I would class them as less liquid. There are some stocks that have average trading volume of less than 500,000. So they are not liquid at all. And the reason why particularly we have to consider which is the most liquid market is because we are not only trying to trade the stock, but we are trying to find an option in the stock to trade. So if the stock itself is illiquid, you can imagine the option will be even more illiquid, and they'll have a wide spread. I've seen options that are, for example, you are able to buy them for example, say $1.50. But if you start selling them, they might be 75 cents. So, buying and selling immediately, 50% of your outlay is gone. Some are even worse. And you might not be able to buy them in a quantity you want at the time that you want. Because if everybody else start buying them, suddenly, the price jumps against you. So we are looking for very liquid stocks with the view that the options on them that we are trying to trade is also going to be relatively liquid. And that enables you then to be flexible in being able to get in and out. And the other flexibility is that on a very liquid stock with a very liquid options market on those stocks, you can find many different strike prices. And that is important because if you've got a stock at say $70 and the steps both upside and downside are in $10 steps, that's a big jump. But if you trade a very liquid stock, you might find that same value stock at $70 might have increment of maybe $2.50 or maybe $5. So that certainly make it easier when you start planning your risk and what strike price you might want to select, because you're not having to jump big rungs. You've got some intermediate levels of strike options available. And you might think this is not particularly a problem, but I'll show you a little bit later on why it can be. And the other thing is that you can't manage such a vast amount of stocks to monitor for a potential tradable target. It's not possible. So in order to have a manageable watch list and not be overwhelmed by it, constantly gazing at charts from one to the other and really fail then to decide which one you would select to trade and then plan a trade on it. So we have to screen them down. So I would suggest that you go into any screening platform. There's several available where you don't have to be a subscriber, paying subscriber. Certain facilities available for free. You can register or join them, and you can then use their screener. And maybe you might go through a screener that says, have a stocks that are valued at least $20 plus. That means all the lower value stocks, many day traders would trade, and relatively illiquid stocks. I'm not saying all of them under that will be illiquid, but certainly majority of them will be. So removing all of them, say under $20, so only focusing on stocks above $20. You might even say maybe you might ignore everything under $30. It's your choice, but that's one suggestion. The other one could be is that you don't want to look at any stocks that have less than 2 million share traded every day on average. So any lightly traded stocks, you would ignore them completely. Doesn't matter how appealing they might look. Doesn't matter how other people are trading those stocks and making bucketfuls of money. It doesn't matter to you because based on your circumstance, you've decided you want a manageable short list in which to carry out your analysis and trade them. So anything below 2 million shares traded on a daily volume, you'll ignore them. Then you might go into other things. For example, you might say any particular market that will be just trading sideways. So for those stocks, looking at options wouldn't really be sensible because you're looking at big moves. So you don't want ones which are caught on a sideways or have a history of maybe say less than like 12 months or some similar thing like that. You might also say that you need a large part of that stock not held privately. Large part of that stock must be with at least about 50% or more held by the institutions. And certainly when we are looking at big stocks, they probably will be, most of those stocks will meet that requirement. And then you might look at a capital value of the company. You might say that you won't look at anything less than an absolute minimum, maybe something like 2 billion, but ideally you want to be looking at higher, something like 10 billion plus, which means that all illiquid stock will be screened out, and you may be then left with possible shortlist. And I carried that exercise out, but it's still quite a large list to go through. My initial screen was showing me something in the region of 150 to 200 stocks. Now I can be ruthless and say take out any ETF, because most of those ETF trades, even though it's a large one, may not necessarily be very liquid. You can go back and individually add some ETF funds, like the oil USO fund or a GLD, which is also an ETF, stocks like that, but not necessarily consider all of them. So having gone through that, you'll have a manageable shortlist, and then you can split that shortlist into industry groups. So you will have a certain number under one industry group, the others in another industry group. So effectively you will have 6 or 7 major industry groups you're looking at, and then approach them with a view of looking at the industry group, seeing what particular industry group is particularly attractive, and then going down to that industry group's member stocks and carrying out analysis and shortlisting it that way. So that's the way I think is a possible solution. You might have some other approaches to shortlisting a manageable risk and not becoming overwhelmed. And result of this would be is that you will hopefully save a lot of time in not looking through stocks which are going to be of very little value in trading and one suitable for your trading plan. So it allows you time to perform quality analysis on the remaining stocks. And quality analysis means starting from a big time frame where possible, like monthly or definitely weekly, doing your big analysis on that, dropping down to daily, identifying possible levels, and then maybe putting alerts on them to alert you when the price is within 10% of that, for example, or so that you are alerted before it reaches the level where you are interested. And in that sense, you can manage to keep tracks of the market in addition to the individual trade that you may be in and trading them. So as outlined, by going through the industry group, then picking the individual stocks, you will be very selective in the actual stocks you will trade. And even within that stock, you will find that some exhibit a better price pattern and structure than others. And some may be at a more appealing stage than others. So in being able to filter through and be selective, you will be left to just handful where you will actually plan the trades on. What this will do is also avoid the confusion as to which one to enter, because you have too many competing potential trades to consider. Once you identify these stocks and plan your trade on them, then you will be, because you've done this early, you will probably sometimes have weeks to sometime maybe a month or more to wait for it. So you wait until it comes to your area, put alerts on so that you don't have to keep watching them every day. As soon as the market gets within 10 or 15% of that range, or if it is already in that 10% range, you might have a price alert to say if it hits a price alert, then you are alerted. And sometimes you may be very close to the actual position you want to enter in, and in which case you identify which option series and maybe then put out limit orders. So not to chase, certainly not to chase, and especially if you're trading big time frame, for a very large swings, missing out a small portion of that price move is not necessarily going to be decimating to you. So you should definitely not chase them where possible. Wait for the trade to come to your level, and then having planned, put out a limit orders and enter them that way. The other thing to watch for is sometimes you find everything is lining up, and you're eager to get into the trading, and you start buying either calls or buying puts. For example, at the moment when the markets have been relatively weak, there are several stocks that have fallen by 20% and 30%, some even more, 50%. So everything is ripe. Which one do you pick? And the idea is that if you enter too many trades in that environment, one, if you have mistimed, you will have probably got them wrong across all of them. The second thing is that it's so easy to get carried away in the sentiments. You might, for example, say, I'll take a contrarian view. So if something is happening and you hear the news reports about something, your price analysis says something else, and you are contrarian, you'll enter. But the idea is that if you do enter in that way, hopefully it will work out, but also you don't want to enter too many positions at the same time, because you could easily get carried away by sentiments, misread the price, miss time. So you limit your trades to just one or two at a given time. Don't have half a dozen a trade entered all in a same day or within a same week, for example. Stagger them. So that will help you manage your emotions, and also control your risk, because if everything goes wrong, then the risk is high that even whatever percentage you risk on each trade, just imagine that your 4 or 5 or 6 trade all could go wrong because you entered them all the same within a same short space of time, and you've been carried over by either overwhelming public sentiment or by your own enthusiasm. Similarly, you will also try and spread the exposure to stocks across different industry groups, because not all industry groups are necessarily in the same cycle. Although I understand that common saying like incoming tide lift all the boats, and likewise the opposite, if the tide goes back, then see all the ugly rocks and unsightly features in the bed of the sea. That's true, but regardless of that, you might find, for example, that some stocks are in a state of congestion, whereas other stocks are trending, up to the upside or downside. So in that sense, if you spread them across different market groups, industrial groups, you will find that you are able to spread your risk and not get them all wrong. Even though, as we just said, we accept that if the whole market is declining, chances are that many of the stocks will also be declining with it. But even in that aspect, as I say, some might be congesting, some might have already declined and are congesting, while others are currently trending. So it will still help to diverse our risk. Position sizing is very important, especially on a small account or a modest account, is that we don't put in too larger positions, because that will immediately put higher risk on our each trade. And secondly, we might use up too much of our capital available in the account, so when other judicious trades do come about, we perhaps don't have the flexibility to consider them. So my general guideline would be is that you don't commit your capital in any open trades. When you combine them all together, it should not exceed 50%. And I would say 60% is an absolute maximum, but ideally keep below 50. Anywhere between 40 and 50% capital employed is good, and the rest of the capital can be sitting aside for potentially future trade that might come up, and the one that you are currently in position for might not be ready to exit. So for that reason, it allows you the flexibility. And then to ensure that on a modest account, for example, if you're entering even a small position, you might need like a couple of $100, 250 or maybe $300. Some positions might require $500. So if you've got $5,000 account, for example, and you've got a $500 at exposure, it's almost like 5%. So you wouldn't really want to go that far, and certainly you wouldn't want to do too many of those. The idea would be is to keep around about 2.5% ideally, and maybe 3% where necessary. But anything over that, you'd have to reconsider, or perhaps plan your trade so you reduce the risk. If you're buying an option and it's costing you 500 and you still want to do the trade but you can't enter because it's exceeding your normal position size, then what you would consider is buying a spread. So you would buy an option, put option or a call option. You buy an option, and then against that you sell another one to bring some income back. So it reduces your capital outlay. So instead of 500, you might now be able to enter because you bought an option for 500 or $5, and then you sold another one maybe for something like $2 or a $3. So immediately now the final capital outlay might be only $200 or $300. So that way you plan your trade and you reduce your position sizing in such a way so that your capital outlay on each trade is broadly speaking around about 2%, 2.5% maximum on a small, like modest account. Once your account size grows, then you might be able to reduce your percentage size to each trade to maybe even 1 or 1.5%. And that would be ideal, but you can't do that on relatively very small account like 5,000. But as your account grows, you'll be able to do that, and then you will only be remitting something like 1% on any one given trade, and you might not even go up to 50% of your capital committed to the market. You might only be using like 25-30%. And what this does is that even if your few trades go wrong, they will not eat up too much into your capital. It will not damage your confidence and your mental stamina, and you won't be put off by the losses, because some of the trade that you plan, as we considered in previous video, which you will be able to view, talking about how options can be used to grow your wealth. In that particular video you will have seen, for example, it's quite possible for options to easily return 4, 5, 6 times and more on big trends. So your confidence will grow, and losing maybe 1 or 2 or 3 positions is not necessarily going to damage your overall confidence and your account. And finally, sometimes you have a very sharp move either in a one day or very sharp move across a couple of days, and this would reflect in your return on your option, because they will suddenly pick up big value within a one day. I've seen options that suddenly double within a day movement. When something like that happens, if you've only gone in with one position, one contract, then you don't have much options but to exit. Especially on a big move, I wouldn't look around. I wouldn't even leave it for a next day thinking maybe market will continue. It might do, but sometimes it doesn't. And when it doesn't, what happens then? It stagnates, and then it begins to eat away into your time decay. Remember we said about illustration of a bucket with holes in them, that each day you hold, the water leaks through the hole, and the water level drops in your bucket. So suddenly if you made a big profit on one day, I would simply take it and get out. Then let the market settle. If it means that on odd occasions you got out too early and the stock has carried on and you could have benefited even more, it doesn't matter, because it doesn't always do that. More often than not, after a sharp movement like that, stock will consolidate. Stock will try to retrace part of the movement, and then when you get caught into that, you might not really gain very much, but holding it on, it would continue to eat away into your time decay. And on a big move like this, the implied volatility would expand, and that volatility will also reflect in your value. But longer you hold it afterward, it will get crushed, and therefore even if the stock carries on a bit further, you might not gain very much because the price movement will go in your favor, but then it will be countered by the collapse in the implied volatility. So it's a trade-off. So I would say that on a sharp move, suddenly in a very short period of time, you don't look around, you get out. That's the nature of the options. It's not like stocks where you made a move, you gain the profit, and then you just wait there to catch your breath and then go for another swing, which could happen. Options are not like that. In options, if you get a sharp move, a move that you were expecting say in 2 or 3 months time, but it's happened in a week, just take it and go. Don't look around. Be satisfied with what you managed. Don't be greedy. Even if you find that you've come out too early, that is entirely fine. You made a good profit and you should be proud of that, and that's a way of helping in a managing the risk of trading in financial market. And we've recognized that trading options are even riskier than the general financial markets for many reasons. The common reason is you have to get your direction right, you have to get the extent of the move right, then you have to time the time it will require for that move to take place. All of these things could go wrong. So that's why when you're in a good position and on a sharp move, you don't then want to be greedy and overstay your welcome. There will be another opportunity. So hopefully these things which are it's not so much academic, and it's not necessarily something you would find everywhere in readily available publications, as I outlined at the outset. These are things that I have noticed and I've reflected over, and personally I think that you can pick out any of these if it helps you, combine them with the other more academic and theoretical things that you might have picked up, which helps you to manage the risk, and you will be successful, you will do well. So if you like this video and you benefited from it, and you wish to continue to receive more future videos and lessons which I will share, then please go to danvi-charting.com, register your interest in there, so that any future communications will be sent out and you will be kept in the loop for that. For now, thank you for watching, and I hope that this has been very useful and practical to you as always.